And welcome to my lecture on step 8 of the accounting cycle, which is closing entries. Now, as you can see from my graphic here, we have 1 month that has all of the dates crossed out. That month is over, and now it's time to start another month. And that is where closing entries come in. So up through this point, we have done all the other steps of the accounting cycle through step 7. And step 7 was the financial statements. And that is really the final product of the entire accounting cycle. That is where we finally communicate everything that happened during the month or during the accounting period. But once that accounting period is over, then it's time to get ready for the next accounting period. And that is where the closing entries come in. Now, before we start talking a lot about closing entries themselves, I first want to go over what you do need to know and what you don't need to know about closing entries. Okay. First of all, closing entries are made automatically by the accounting software. There is no human who actually enters in the debits and the credits and the accounts for the closing entries. It's automatically done. Because of that, I do not think it is necessary for you guys to know the actual closing entries, the accounts or the debits or the credits, not necessary. The book is going to go over them in great detail. I am not requiring you guys to know that. It's not in your homework or anything like that. However, what you do need to know is the purpose of the closing entries, what they do, and why it's important that they happen. Okay. So there are two main purposes of closing entries. Like I said, the closing process gets you ready to start the next accounting cycle for the next accounting period. So before you can do that, two things need to happen. First of all, you must return the balances of the temporary accounts to zero. And I've got my little funny zero character there. And I'll explain to you momentarily what temporary accounts are and why it's important that we return them to zero to start out the next accounting period. The second thing that needs to happen before you can start a new accounting period is to update the balance in the retained earnings account. And I'll talk to you guys a little bit more about that momentarily. So first of all, let's talk about permanent accounts versus temporary accounts. Permanent accounts are accounts that have balances that are continuously updated from one accounting period to the next. Meaning, when November ends, those things still stay there when we start December. Okay? So those are going to be our assets, liabilities, common stock, and retained earnings. And my hint there is those are all the accounts you're going to see on the balance sheet. So let me give you some examples of those and why they are considered permanent accounts. My first example here is cash. Okay, so say it's November 30th at 11:59 p.m. and you go and you check your bank balance, and the bank balance says, in this case, you have $77,245.39. Whoa, holy moly, you've got a lot of money. That's awesome. But let's say the clock changes and now it's December 1st, 12 o'clock a.m. So literally that split second between November and December. If you go back and you look at your bank statement balance, do you expect it to be all gone and say all of a sudden that you're broke? Where did all my money go? No, that is not the case. Whatever money you have at the end of November should be the same money that you have at the beginning of December. It doesn't just go away because November is over. Therefore, it's considered a permanent account. Okay. Another example, automobile. So let's say you have a vehicle that you use in your business, maybe a delivery truck. If you have a delivery truck sitting in your parking lot as of November 30th at 11:59 p.m., if you then go out to the parking lot on December 1st at 12 o'clock a.m., so literally that split second when it turns from November to December, are you going to be like this guy going, dude, where's my car? No, your car should still be there. It doesn't go away just because we went from the month of November to December. Okay, so yes, there again is another permanent account. Let's talk about liabilities. Okay, same thing. If it is November 30th at 11:59 p.m. and you owe somebody money and that debt is hanging over your shoulders, do you wake up on December 1st at 12 o'clock a.m. in the middle of the night going, yay, I'm going to run through a field of daisies and shout for the hills that I am debt-free, yay? As much as we wish that would happen, no, it does not happen. If we owe somebody money at the very end of November 30th, then we expect that we still owe that money at the very beginning of December 1st. Your debt does not go away just because we went from one month to the next. Okay, and another example of a permanent account is common stock. Okay, so common stock, as we've already discussed, represents an owner's ownership because the owners contributed to the business. So if you were an owner as of November, because you contributed money in November, do they all of a sudden take your ownership away when it becomes December? No, you're still an owner. Your ownership doesn't go away just because the month ended. You're still an owner until you sell your stock, and we'll talk about that another time. Otherwise, you are still an owner. Okay? So that is permanent accounts. So the key thing I want you to note here is that these are accounts that continue to exist and still be there from one month to the next. We just, in our balance sheet, took a quick snapshot of what it looked like at the end of the month, but that doesn't mean it went away at the beginning of the month. We just took a quick snapshot, and it'll still be there to start out the next month, and from there, we're going to update the balances up and down for whatever happens in December. Okay? Now, let's contrast that with temporary accounts. Temporary accounts are accounts that accumulate for only one accounting period at a time, and then at the end of the accounting period, they go into retained earnings. Okay, so those are going to be our revenues, expenses, and dividends. And as a hint, those are all of the elements that go into our statement of retained earnings. Okay, it's our bridge that gets us from one month to the next. But these are the action items or the things that we do in between that get us from one month to the next. So let me show you why those are considered temporary accounts. Okay, so again, here is the formula of the statement of retained earnings. We have our beginning retained earnings at the top. We add in our net income, which is revenues minus expenses. We subtract out our dividends, and whatever's left at the end of that is the retained earnings that we still hold at the end of the month. Okay. So first, let's talk about revenue and why revenue is a temporary account. Okay. So revenue, as we've already discussed, is goods and services provided during a given accounting period. So by definition, we only track revenue for a period of time. In other words, if we sell stuff, goods and services in the month of November, that is an action that happened in the month of November. And what you sell in the month of November has nothing to do with what you sell in the month of December. They are two totally separate things. Okay? So basically November revenue goes away, it stops happening when you hit that new month. So December, we start tracking again. We start out at 0, and then we start tracking our revenue or the goods and services that we provide during the month of December. Okay. Now, expenses are also a temporary account, and here's why. Expenses are goods and services that are used up in the process of earning revenue. And because of the matching principle, which is a very important principle in accounting, we match our revenues with the related expenses. So any revenue that we track for the month of November, for what goods and services sold in November, we're going to track expenses for that same accounting period. Then in December, we're going to start all over again and track our revenues that happen in December and our expenses that happen in December. Okay, so these things are tracked separately by accounting period or for a period of time. The third temporary account is dividends. So let's talk about dividends. Okay, so as we discussed in previous classes, revenues minus expenses gives us net income, which is also called earnings. Now, that net income or earnings can go to one of two places. Either we keep it in the business, and if we keep it in the business, that means it is retained earnings, and retained earnings are considered permanent because they're staying in the business. Dividends, on the other hand, is if the owners take the earnings out of the business. Okay? They take cash or whatever other assets out of the business. Well, in that case, those earnings are temporary because they are not staying in the business. The owners took them out, they're gone. So those are temporary. So, as a quick recap, permanent accounts are the accounts that stay there from one accounting period to the next. When we go from November to December, they're still there, and that's our assets, liabilities, common stock, and retained earnings. And our temporary accounts are those that we only track for a period of time, and then they're gone at the end of that month or that accounting period. And that's our revenues, expenses, and dividends. So we've talked about why it is important to return the balances of the temporary accounts to zero so that anything we track just for a certain period is cleared out to start the next accounting period, and then we start tracking our December accounts. The second thing that closing entries do is it updates the balance in the retained earnings account. Okay, so again, here is that statement of retained earnings. And what essentially happens is we need to update the balance that is in our ledger in the retained earnings account from what it is at November 1st to what it is at November 30th. So in the statement of retained earnings, we show how we condensed net income and dividends into retained earnings. But this is just a statement. This is just a communication. It doesn't actually change the numbers in our system. But the closing entries do change the number in the system and actually update so that our system, if we looked at the ledger for retained earnings, would show in our system that we have that ending retained earnings amount. Now, I'm going to show you an example of this in my next video, which is on step 9 of the accounting cycle, and I'll go through using the numbers that we used in our in-class activity. But that is the end of my lecture on the accounting cycle, step 8, closing entries. If you have any questions, I encourage you to read the book, use the reading guide so you can see the important pages and terms and concepts that I want you to look at. And if you still have further questions, please feel free to email me with any questions, and I will try to further explain it for you. Thank you so much for watching. Bye-bye.